welcome everyone to episode 177 of the Trust the Plan podcast. I'm Nick.
And I'm Jim.
Jim, it's good to have you back.
It's nice to be back.
Thought Preston was going to take over for a while.
He did a nice job.
Yeah.
I give him credit.
Yeah. He has some big news, so we wanted to, give him some time.
That is exciting. Though I'll say the one piece of news that I'm jealous of is that he was able to graduate college with the academic requirements to sit for the CFP exam right away.
Yeah.
During my journey, that took me probably 18 months to get through the curriculum alone, and then another 6 months to study. So that was a nice, it's a really nice route for kids to be able to do.
It's 2 years.
Yeah.
It took me 2 years as well.
Yeah.
So I totally understand that.
Mm-hmm.
So we have 3 CFPs now on the team. So we're, I'm really proud of that.
Yeah,
really proud of that.
It shows that, we're all taking it seriously and putting in the time and energy to learn as much as we can and, help the clients as much, best that we can.
Of course. So what's on your mind today besides the CFP?
Well, the one thing that I was thinking about, I came across an article that talked about money markets, our CDs at the bank, right? Everybody knows that short-term rates are up and people are excited about CD rates, and we kind of keep hearing that from different people is, what about these CDs? Shouldn't I get one of these CDs, right? Kind of like we heard it back when I-bonds were pretty popular too, right? Mm-hmm. You hear the investment of the week kind of deal, right? So that was something that popped up, and one of the comments I saw in an article even talked about, why would I even need an advisor? I can just put it in a CD and make 5%.
Okay, so we're saying we're going beyond, let's do what we can to earn a higher rate at the bank, but we're actually going to terminate the advisor as well.
Yeah.
Okay, which means like moving your retirement accounts from Schwab or Ameritrade to the bank.
Yeah.
Right? And okay, so like I'm all for getting extra cash, extra interest on my cash.
Yeah.
But now we're taking it a little bit too far, right?
That was the first thought I had too, is man, that's pretty extreme to think about selling out to one asset class only, right? Taking all of that money, parking it in a CD and thinking that's going to be the best investment and the only investment you're going to need for the rest of your life. It's pretty bold. And
short-sighted, because these CDs are like 1 year, 2 years, right? That's where the highest rates are right now, a little over 5%. And, if your plan works for 5%, that's great. But, if your plan, like I'm 43, I need a 50-year plan.
Yeah.
Right? Not a 2-year plan.
Right.
Okay. So my personal philosophy, and then we'll go into all the other problems. My personal philosophy is we need the smallest amount of money in the bank as we're comfortable with. So I'm not talking about emergency reserves and anything. I'm just talking about your checking account. So a couple months of expenses max in that checking account, and just map it out. Like, what are your anticipated needs, and make sure that you have enough. All the rest, for me, needs to be in a money market. All of your cash needs.
Yeah, I would say similarly. If you got your checking account, your pay the bills account, maybe you want to be a month ahead on those expenses just in case something pops up or whatever. But that's how I think as well, is just keep that checking account low and put all the rest of the money to work somewhere. Not just taking it one step further, being taking on a higher interest rate. For money that you don't think you'll need for a while.
Yeah, and to be clear, we're not saying don't have an emergency reserve, right? We're saying the emergency reserve shouldn't be in the checking account.
Yeah, put it where it's going to earn something.
Or I'd say in the bank at all,
because
the money markets are superior right now at 4.7%. You can get like a CD that's probably 5%, 5.1 right now, but I don't want to lock it up for a year if it's only worth 0.4 extra.
Yeah.
Right?
I agree completely. And going back to that original question we posed about CDs, that's one of the biggest things in my mind is locking that money up for 2 years to get that 5% rate. For me, a little lower rate of return for 100%, daily liquidity is huge. It's kind of a no-brainer.
The liquidity. I agree completely on the liquidity. I want to have, if I change my mind, I don't want to have a penalty. If I need money now, I don't want to have a penalty, and I don't feel like the 0.4 is worth it. Okay.
Yep.
And then the other thing that you could say is, well, in a year from now, we could have lower money market rates. So you could buy a CD for a year and get your, let's say 5.1, okay? Because I was looking yesterday and that's what I saw.
Right.
And that's a good rate, okay? But in favor of the CD, the money markets are at 4.7, and they could go down between now and 1 year from now, which I would think they will a little bit, because the Fed is going to have to probably pivot, meaning they stop raising and they maybe start cutting. So I would expect that. So the CD probably will make more, but I don't care. Right? The other things that you said are important. But the 4.7 could be 3.7 in a year.
You're right. Yep.
So,
agreed.
So that's something to think about. But either way, inflation's 5.0. So we're not making any real money.
It's a great point, because it's easy to get excited about short-term rates or paying again. We're finally getting paid interest on our money, and that's great. But if we're just matching inflation, we're just treading water, right? We're not really making any progress.
Yep. And so the other thing that he talked about is, or the conversation was in the article, well, what happens after a year is up, or after 2 years are up? Then what do you do?
Yeah, and you were starting to go down that path a little bit, but there's a reinvestment risk, right? What happens if you're getting 5% today, and in 2 years when the CD comes due, it's only paying 2%, right? So now you only have, your choice of investments at that point are only another low-paying CD, or trying to pivot into something that would pay more, like maybe a bond fund. But if you had been in a bond fund the whole time, as rates were going down, we know that the value of that bond would have gone up.
Yes.
So there's a lot of lost opportunity there in price appreciation on the bonds if that were to be the case.
So let's also say rates go down 1%, okay? So in 2 years, or when the reinvestment comes up, instead of making 5.1, now you're only making 4%. Well, now, if your 4% return, if your financial plan requires 5% to be successful, now what do? You're locked in at 4, maybe the market rallies and you're selling stocks today, and you have to buy back in at a higher price, or it's just a mess.
That's really true, because if the Fed cuts rates like we think at some point they would, that not a prediction, but that would likely spur on growth in the market, and we would see a good market return based on them cutting
disclosure
rates.
Full disclosure. No
Right.
crystal ball.
Right.
Okay. I just thought of another thing. This is excellent parallel here. Do you remember the Boons and Clawsons booklet that American funds used to have?
No,
Okay.
I don't.
All right. So in 2001 is when I graduated, and they would send out marketing materials, right? And so this one is called the Boons and Clawsons. It's just like a picture of a couple on one page, they're super happy, and a picture of another couple on the other page, and they're like with frowns, they're upset.
Right.
So the story is, right, and I can't remember which one was which, but let's say the Boons, the happy ones, they invested in the market in 1980, and they had this 20-year raging bull market basically from the early 80s until 99, right? Like double-digit returns, huge numbers, just wonderful ROI. And so they're happy and smiling. And then you have the Clawsons over here who are upset because in 1980, remember how high interest rates were? Like double-digit treasuries?
Right.
Let's say 10%. They bought a 20-year treasury at 10%. Who wouldn't like that?
Yeah.
Right?
Right.
I mean, my plan would work with a 10% return.
Yeah.
Okay. So then in 2000, when it comes up to reinvest, that 20-year bond was like 4%. Okay. So now they got to reinvest, and they're going to make less than half. So they're upset. Okay. They missed out on the bull market, which which would have had way more, and now the income and interest that the treasuries are going to kick out are not enough for their financial plan to work.
Plan doesn't work.
Plan doesn't work. So the Boons and Clawsons are a good parallel here too.
Definitely.
What else here? What about the call risk? Okay.
Yeah, that was the other thing I was going to mention. There is call risk as well, and what that means is people may say, well, if I get in a 5% CD today, I don't care what happens. I'm just going to be happy I got that. Well, if rates go down and the deal's not as good for the bank anymore, and they can't afford to pay that because maybe interest rates are half that now, right? And they're only 2%. Well, the bank will essentially refinance that CD. They'll buy it back from you, and they'll reissue it at a lower rate. So just because it's good now doesn't mean it's good forever, right? Because there's a risk that they call that CD back and they basically essentially refinance it and give you a worse deal.
And a lot of banks have that in the terms of the CD. You have to read the fine print and make sure that it's one that you're comfortable with. Mm-hmm. So let me also say this: when you go to your local bank, the rate is the rate, okay? But at Schwab, Ameritrade Schwab, there's brokered CDs, and so we can choose from 100 banks that we want to look at. And when banks compete, you win. Remember that tagline? So, we probably, in a lot of cases, have better rates than your local bank. So think about that with the CDs as well.
Yeah, very true.
And the money markets are, second to none.
Yeah. And I would say the biggest takeaway from the article, though, is something like that totally negates the value that the financial planner adds, right? If you were to say, well, just put it all in a CD, take your 5% and be happy, right? Because there's so many opportunities that are probably missed. There's so much optimization that's missed. Like you said, does the plan work? I doubt that they even know if the plan works, right? The hypothetical, the story, right? Does the plan even work at 5%? I bet they don't even know the answer to that.
Right.
Because they haven't done the work to...
Because they fired their planner.
Right, right.
And a lot of planners don't plan. Don't forget about that.
Oh man, we could do many episodes on that topic.
I think
we run into it all the time.
I think we already have.
Yeah.
Oh, I have one more idea besides planning, which really should be like the number one thing that you're losing with this deal. But a muni money market. This is something that I've been talking more about with people in the top tax rate. So if you're paying 37% to the Fed, I think the muni rates were like in the mid threes. Don't quote me, okay? Full disclosure, not a recommendation, right? That kind of a thing. But if let's just make up a number, 3.6% on a muni money market, it's less than the 4.7, but it's tax-free, federally tax-free. The equivalent is like 6%. Yeah. The taxable equivalent yield. Mm-hmm. So that is very attractive if you're in the top tax bracket.
That is a great point. Yeah.
Okay, anything else on this topic?
I think we've covered it.
Take us out.
Yeah, so if you have questions, if you want to know what you should do with your safe money, if you're looking for a second opinion, feel free to reach out to us at peakwm.com. You can schedule right online or pick up the phone and give us a call, and we're happy to meet with you.
# no lazy money. All right, see ya.